In this video, we're going to talk about how to reduce risk while you sell naked call options. If you recall what naked options are, basically you get to collect a premium, but now you are obligated to sell 100 shares at a certain price on or before an expiration date. For example, if a stock is at $100 and you sold a naked call option at 105, if the stock stays below 105, you get to keep this dollar amount that we talked about. However, if the price goes above 105, you become obligated to sell 100 shares right here at 105. And if the stock's trading at, let's say, $130, you could see why that would be an issue, because that means you have to sell it at 105 and you have to buy it in the open market for 130. You'd basically take a $25 loss per share minus a premium. It's going to be slightly less than $25 times 100 shares. So that's going to be about $2,500 of loss. So it could be a potentially risky strategy. So here is a way to actually reduce the risk. And it's actually one of the most popular strategies within the option selling community. This is known as the covered call. It's the same thing as selling a naked call option, but the only difference is you also buy 100 shares. So let's take a look at this. Let's say stock again's at $100 and you sell a call option at 105. Again, if the stock stays below 105, that's great. You get to keep the premium you received. However, if the price goes above 105, remember you're obligated to sell 100 shares at 105. Well, lucky you, because you already bought the 100 shares. So you just go ahead and you deliver it at 105. So regardless of what the market is trading at, it could be trading at 130, it could be trading at 200. It doesn't matter. You already have the 100 shares and you don't have the risk on the upside. The only thing is you do have a giant opportunity cost. As in, if the stock explodes to, let's say, $300, you miss out on literally $200 worth of gains. And that's probably going to hurt you emotionally. I mean, I'm sure that would hurt me. It's like, dang, I was bullish on the stock and I missed out on all these gains. So the risk is mostly on the opportunity cost. The other explicit risk is also if the underlying, the stock, goes lower. So yes, you still get to keep this premium, but the problem is, let's say the stock's actually trading at $70. You're still going to take a giant loss on this $30 difference, because now the stock that you bought for $100 trading at 70, yes, you got to collect a little bit of premium, but you're still going to be down almost $30. So the risk is still there. But if you think the stock's going to be range bound or just slightly bullish, this is a fantastic strategy. If you are just altogether bearish, this is probably not the best strategy, because you do have this potential loss risk, as in the market could just continue going down and you're going to lose money on the underlying going down, even though you're collecting all this premium. Now you may be thinking, if I sell a naked call option, I have significant risk if the market moves higher, but I can make money if the market goes down. Now we could hedge that risk by buying 100 shares of stock, and then your only loss is if the actual stock goes down, the unrealized loss that is going to impact your overall P&L. There is another way for you to make money as the market goes down by selling call options without having to buy 100 shares of stock. You can learn about it right here.